The JP Morgan yesterday moved 3.6 million ounces from their eligible stockpile of silver to register to provide more potential liquidity for the market. I think there was something like 5 or 6 million ounces over a 2-day period that they had moved. So JP Morgan certainly taking some of their silver hoard just in storage on the COMEX depositories and putting it up potentially for contracts. I don't know if that's for March or in preparation for a later month, but it looks like JP Morgan kind of got the signal or the thought that there needed to be more physical liquidity on COMEX, and so they have upped their. Hey everyone, this is Rob Kientz with goldsilverpros.com. We are reporting on Friday, March 3rd, 2023. You guys will see this up on the channel in a day or two. This one is titled "The Schizophrenic Economy Leaves Investors Confused," because man, there's just a lot of different stuff going on. Let's talk about it. So as we always do, we're going to start off with gold and silver price. Gold is up 17 bucks today on midday trading. It's up to 1855.48. Silver is up 31 cents to 21.26. Gold's up about 1% of the day. Silver about 1.5%. Nice to see those rebound after basically having sold off since early February, starting to make a bit of a rebound in the last couple of days. Go gold, go silver. The markets themselves are doing okay. The Dow rallies 300 points today as Wall Street heads for a weekly gain. Not a lot of news as to why, because the jobs report, unlike most first Fridays of the month, is not out yet. It's coming out March 10th, so we're going to get a little bit of a delay on the jobs. And so I think the market is just ending a little bit on a high note, even though the economic data is probably sort of confusing. Let's go through that real quick. Durable goods orders are down 4.5%. They were expected to be down 3.6%. Last month, they were up 5.1%. So a lot of the durable good type of industry, people that buy durable goods, businesses that buy those types of goods, it's down, which is a sign that those businesses may not be doing as well, although it did okay last month. So I said that's kind of schizophrenic. Up 1 month, down the next. We'll have to see what happens. It seems like the economy is seesawing just a bit. Pending home sales, again, after we've had months and months of really horrible data on real estate, pending home sales are up 8.1%. Last month, they were only up 1.1%. And the economists only expected them to be up about 1%. This month, they're up 8.1%. That's a tremendous number, and that's good for the housing market. I'm actually very happy to see that after months and months of just negative housing data. We had just a little bit of a nice little pop there. The U.S. trade balance in goods is down 90.5 billion. It means that we're buying 90.5 billion more this month than we sold. And so, we're still a consumer economy. We all kind of know that. Retail inventories about the same. Home price index actually up 4.6%, lower than expectations. So that housing stat's not quite as good as the pending home sales. Up 4.6 is good. Last month it was up 6.8, and they expected it to be up 5.2. So it's a little bit disappointing in terms of the home price index, but at least we had some sales in there. So at least there's some inventory moving. The Chicago Business Barometer was down to 43.6, well below expectations of 45. Consumer confidence was down to 102.9, below the expected of 108.5. I think consumers this month had less overall enthusiasm for the market in terms of credit card sales. We've already seen that come through. And then in terms of retail sales, we've seen that down since the beginning of their last 2 months. So consumers are not quite as ebullient about the economy as they were because they're not spending. And that's why the consumer confidence survey, we would expect it to be lower. And it is, which makes total sense. ISM manufacturing is at 47.7. Because that's below 50, it's considered to be contracting. So it's not great, but it was slightly above what the consensus expectation was, which is 47.6. So at least we met the number there, and manufacturing is not plummeting more than we thought. So that's nice. It's a nice little plateau on manufacturing for this last month. U.S. productivity up 1.7%. Thought it was going to be up 2.5%. So productivity is not quite up as much as people expected. But hey, it's a positive print. I will take that one. Unit labor costs have gone up, meaning the cost of labor has gone up 3.2%. More than double expectations of 1.4. So we see some prices rising in the labor market. So again, it's kind of a back and forth economy. A couple of nice, prints on real estate, a little bit on manufacturing, not contracting. But then some of the real estate, the home price numbers were down. Some of the other durable goods orders and things like that were down. So really just kind of have to see, what's going on. I don't see anything definitive there about what's going on with the economy. A couple of big stories. The layoffs in tech continue, according to a Statista article as of March 2nd, 2023. Total worldwide workers laid off in the tech sector since the beginning of the year, 283,402, 68%, ladies and gentlemen, come from the United States. Only 32%, or 1/3 of the tech workers, were laid off worldwide. That means the US tech companies really got hit the hardest, double the rate in the last quarter of layoffs that the entire rest of the world was combined. That's huge, led by Amazon with 18,000, Alphabet, which is Google's parent company, at 12,000, Meta, Facebook's company, at 11,000, Microsoft at 10, and Salesforce at 9. Peaked in January with over 80,000 layoffs that month. About half of that in February, 40,000, but the trend continues, and it's been up since October of last year. That's right, it's been up since October of last year when the tech sector laid off just under 20,000 jobs, and that has continued on through February of 2023. That is a really big story. Another big story was earlier was a report that the UAE may be leaving OPEC in terms of that oil alliance, which would be a huge impact on OPEC and reduce its ability to provide reserves to the world. Oil was sliding on that, but it started to reverse after both Reuters and Bloomberg say that the Wall Street Journal report of the UAE leaving is far from the truth. So we've got conflicting news agencies. Wall Street Journal on intelligence report saying UAE is leaving OPEC. Bloomberg and Reuters say, hold the phone, we're not sure yet. Let's take another look at this because it's far from the truth according to our insider resources. We don't know which reporting agency has it correct, but if the UAE does leave OPEC, it makes the UAE an independent. They can take their oil independent, and it reduces the power of OPEC in terms of the market. That's probably why the market was selling off just a little bit, I would imagine, but now that's recovered. So we'll have to see what happens to energy. Energy is a huge component in the entire worldwide economy, which is why we wanted to cover it. That could be potentially a big deal. And again, we'll pay attention to that, as needed as we go forward. So on the screen share here, we've got gold up on CME Group. And as you can see, we've had sort of muted volume dating back to the beginning of February. Of course, we had that ION report at the beginning of February of a cyber attack. ION, third-party data provider, was not able to provide the data. The COT reports are not updated. They're about a month behind. I'll show you that in a moment. And so for the last month, we've had a lot lower trade on the metals markets, both gold and silver. I haven't looked at the details of like agriculture and energy, but I imagine those trades would be somewhat down also because the CFTC has reported and the CME Group has reported they're manually processing some transactions still. At least that was the last report in the middle of February. So we still think that some of this is manual. So the overall trade volume has been down the entire month. Of course, February wasn't a huge delivery month, but even though it's not a physical delivery month, still expected to be a lot of paper trading, and it's down. So you can tell the overall trend is down in gold and silver futures, but it's still there. And so we're going to analyze it, and it's still important. So as we look at the data, we have Thursday's data here. The dominant trading month is April 2023. You can see because I had 322,863 open contracts at the close of the market. The next big month in order would be 72,877 contracts being traded in June. Almost 17,000 in August, 15,000 in December. December is a big trading and potentially delivery month for both gold and silver at the end of the year, but gold and silver trade different months throughout the year as well in terms of which ones are going to be big trading months, which ones are going to be a little bit more softer trading months. Generally, about 6 months of the year for gold and silver are considered heavier than the others and kind of stand apart from the others. And the one that is in gold is April 2023, as you can see here on the chart. All right, moving over to settlement data. This is where we get the pricing data. I go over 1 or 2 days worth of data on this just to show you how it works. Of course, you can go to the CME Group website and look it up. They'll give you 5 days worth of data. If you sign up for Gold Charts or Us, you can get more data on this service, but that is a paid service. So I'll let you guys decide whether you want to do that. I use it, of course, and bringing that data just to provide it to you on the weekly market wrap up so that you have it if by chance you're not subscribed. In any case, back to CME Group's website, you can see the volume for Friday. We get more up-to-date volume numbers. Their report intraday on the volume numbers. It's not the absolute latest data, but it's sometime on Friday today. So far, we have 135,000 contracts-ish that have settled. It's up $14 on the day, as you can see here. And so the settlement price is about $18.5460. If we look at the gold price, that's about what we see on goldprice.org. So as you can tell, this is basically what determines the spot price. For all intents and purposes, now you could average in some of these contract trades, but really it's the closest near dominant trading month, which really determines spot. Some of these other months can kind of drag on it, but not really. And then if we go back to Thursday's data, we see 140,000 contracts on Thursday's data for gold, trading down about $5 to settle about 1840. That was the last couple of days. We're going to move over to silver, but we're going to look at gold around the world first. And as we look at this famous chart that I've done so many times from Gold Charts R Us and Nick Laird's service, you can see that COMEX is basically the USA gold. The rest of this is considered London plus other places. Like, for example, GLD probably put some of their gold in London, in New York, if I remember correctly from the prospectus. I know SLV does, and I think GLD does as well for gold. I have to go back and look, but some of these other ETFs are not all stored in London either. But this basically, a lot of the metal here is stored in London. The biggest ETFs do in any case, the GLD and the SLV, and so it's a good idea of what's going on in the London market, at least kind of a proxy number, if you will. So in any case, getting on to the COMEX data, we're down. It looks like almost 2 million ounces over the last 4 weeks. And I just gave a 4-week number, and then we look at the daily number. So it's down both. That means gold is flowing off the COMEX, and it's been doing that for quite some time. We've been talking about that. What about in London? We'll use the GLD, and you can see this is the GLD ETF right here, because I clicked on up here GLD. Now, if I clicked on IAU, you get the IAU chart, but we want to do GLD because it's the biggest by volume and by amount. And so since silver squeeze in the beginning of 2021, gold has been coming off of the overall London market, or at least from GLD specifically. And there's a little bit that's come on recently, but that's the overall trend. And if you look at the overall trend for the rest of the world, given about 2 million ounces come off of COMEX and only 1.6 million ounces total, COMEX and all the ETFs together, that means the ETF demand has actually added about 400,000 ounces in the last 4 weeks. So there is a little bit of gold added overall to the ETFs, but when you consider the gold taken off of COMEX, the net drop in world inventories over the last 4 weeks off of these two major markets is 1.6 million ounces. Moving over to silver on the CME Group's website, we look here. Silver has had some pretty good trading numbers. So unlike gold, silver seemed to have recovered from the ion issue, and trading is fairly robust. And given that February is not a big delivery month and didn't have just an absolute ton of contract trading, to see these numbers is actually really good. It means that there was a lot of paper trading going on in the market that month, probably more than I would have expected. You can see here just by the numbers that May is the dominant month in terms of open interest on the COMEX for silver at the moment. Of course, you saw 1,776 contracts roll off. And so people are either closing those contracts or rolling them to subsequent months, which you can see in the positive numbers. Overall, though, the activity is slightly down for the May month. We had EFP 750 go over to London. We had 362 delivered on the March contract. March does not have a lot of open interest left, so I don't expect the deliveries to just peak. But I think prior to today's numbers on silver, we had something like 2,500 delivered contracts for March so far. Another 800 or so were up for delivery. We've got 362 here. So we added about 2,900 contracts delivered, for silver on the month. It looks like about that number. Of course, in a couple of days, we'll start getting closer to what the total will be as these contracts dwindle, and we'll pay attention to that for you. We go back to Wednesday's data, basically the same thing. May is the dominant month, and actually people were still putting contracts into May, although on yesterday's data, they were rolling off. So overall, May is the healthy contract month for silver. And if we look at the settlement data, this is as of Friday, so this is intraday. Again, some trading data today. The dominant month is May. 48,000 contracts have closed so far today, up an average of 34 cents to 21.23 in the silver market. A nice positive day for silver so far. We'll see what they close at when we come back and look at this again next week. And looking at yesterday's data, this is Thursday's data, so we see right up here on the drop-down box right there. And we see again, trading May, the dominant contract month, although we had nice healthy trade in July and a little bit in September and December as well. So you can see these will be the likely months to get a lot of the silver trade going forward. But since May is dominant, we talk about that one. And on Thursday's data, down 20 cents to 29.01. And if we look at the same inventory data, the physical data around the world, we see that actually a lot of silver has come off of COMEX in the last 4 weeks to the tune of about negative 11.5 or so million ounces. Overall, only 65,000 between the ETFs and the US market. So that means all of this loss from COMEX has basically come on to these ETFs. So I don't know if that means people are taking delivery from COMEX and putting into the ETFs, or if the markets are functioning separately where people just want to get it from COMEX and people, with the ETFs just want to passively invest. It could be two separate trades. But it's interesting to see that the demand of silver off of the American market seems to very closely have matched the demand for silver into the ETFs and the passive investment over the last month, to the tune of there only being a 65,000 ounce difference between the numbers. I find that very interesting. In any case, silver's rolled off since silver squeeze. A little bit of increase here, not much. So we do have some silver in both London and in the US on COMEX and the London OTC market. Not a terrible amount. If there's going to be a physical run of metal on those markets, it would be silver before gold, because I believe there's less overall silver liquidity than gold when compared with how much is demanded every month, how much is delivered every month, and what the stockpiles are, and considering the fact that most silver is used in industrial applications and probably is never going to flow back onto the COMEX because it's out in cell phones and all this stuff, whereas most of the gold is held in jewelry or bar form and could be brought back onto the market. I think it's pretty clear to see that silver would probably run off first before gold, but that doesn't mean there's going to be a huge inventory shortage. We did report, I believe, yesterday on Twitter, the JP Morgan yesterday moved 3.6 million ounces from their eligible stockpile of silver to register to provide more potential liquidity for the market. I think there was something like 5 or 6 million ounces over a 2-day period that they had moved. So JP Morgan certainly taking some of their silver hoard just in storage on the COMEX depositories and putting it up potentially for contracts. I don't know if that's for March or in preparation for a later month, but it looks like JP Morgan kind of got the signal or the thought that there needed to be more physical liquidity on COMEX, and so they have upped their physical liquidity from their individual storage facility. So we'll have to see if we expect much higher deliveries in silver going forward. But a little bit of a sign from JP Morgan that they needed more liquidity and added, 5-6 million ounces over 2 days to that in case we were going to have that many deliveries on COMEX. And again, I've seen about 2,900 contracts worth of deliveries in silver. So maybe that's some of the demand that's being fulfilled. We'll have to see over the next couple of days how March goes in terms of physical delivery, but it did look pretty frothy early in March, although I don't think at the end of the day, March is going to be a huge delivery month for silver or for gold on the COMEX. I could eat those words later, and it looks okay, but not really strong. So we'll have to see. But there is some delivery, and March is traditionally a pretty good delivery month for silver, at least. So, hey, we've got some healthy numbers there. I don't know if that portends that we're going to have a very strong delivery market for COMEX the rest of the year, because we've kind of had okay numbers so far, but it's not like it's like punching you in the face or anything. So we'll just follow that as we go along. That's going to do it for today, guys. I think I gave you the big stories, the big economic data, did the review of gold and silver, as we do every week here on the channel for the weekly market wrap up. I've been your host, Rob Kientz, and I run Gold Silver Pros. Until next time, and have a wonderful week.